Welcome to today's presentation here at Nhr Condon, where we'll be discussing retiring and investing in Portugal for U.S. expats. First, my name is Stan Farmer. I'm one of the advisors here at the international team. I'm going to turn it over to Keith Poniwaz, who's going to talk a little bit more about our international practice here at Nhr Condon, and then we're going to start talking about Portugal.
Hi there, I'm Keith Poniwaz, Director of International Advisory Services at Nhr Condon. We have a growing practice in the area of helping expats, American expats specifically, worry about their finances when they move abroad. We've been working here as a team for several years, but Nhr Condon has, because of our connection to the University of Wisconsin, years of experience working with folks with international connections. Our team consists of 3 people. First of all, Sil Michelin, who will be presenting on this webinar as well. He's a chartered financial analyst. He's also an expat himself, moving here to the United States from France, and he has a background having lived as an around the world, not as an American. You are now an American citizen, though, Sil. He's lived in France, London, Switzerland, and in the United States, and so has a lot of first-hand experience with some of the issues we've discussed. I'm also joined by my colleague Stan Farmer, who's a certified financial planner and, as he likes to refer to himself, a recovering lawyer, a JD as well. Stan is our most first-hand experienced in sort of issues dealing with expatriates in Portugal. As part of his work in international finance, he lived in Portugal for a while, along with Angola and the United Arab Emirates. So he has quite a bit of first-hand experience working with folks in these situations. And so accordingly, he'll be the one doing the balance of the presenting today, with Sil and I chiming in here and there. What we rely on for our expatriates in terms of our process for getting them moving is really a 4-part process. We start with gathering information. We call the process GAP, and really that's our first step, is to gather information. So if you are interested in learning more after this webinar, we'd really encourage you to reach out to us, speak to us via email, and then we can set up a time to chat via Zoom or phone. And we can then, from there, start gathering information about your situation. Accordingly, once we gather that information, we start to analyze it, even starting on the call. We'll look at, okay, what are things that you can do immediately before even we start the full-on financial planning process, which is our 3rd step, that can help you expedite your move, make it simpler, simplify your life before you move abroad. And then finally, after we've worked through the planning phase, which involves us presenting a financial plan to you, also presenting, sort of making sure we have compliant investments for you that make sense in your new jurisdiction, we work to further customize and implement that plan for you as we go on. What we should note as well is that in that process, it doesn't just stop. It's not just 4 steps and then we end it. It's constantly ongoing. In there as well, we rely on our expertise to make certain decisions that will make your life easiest if you were to move abroad. These include jurisdictional analysis, and I think you'll get a good sense of what we mean by jurisdictional analysis today as we speak specifically on some of the issues you'll face if you move to Portugal. Related to that, obviously, is the financial planning and investment management side, which we alluded to earlier. And then, we gather information about your risk tolerance and, implement that. And then, and this is a big reason why Portugal is so popular to so many American expatriates is tax efficiency. And one of the things we try to do is work with our clients to put them in a position where they can maximize the advantages, for instance, in Portugal, of Portugal's non-habitual resident program, which is something that we'll speak quite a bit about today. With that, I'm going to turn it over to my colleague Stan Farmer, who's going to talk more specifically about what's going to go into this webinar today, which is really an example, Stan, of jurisdictional analysis.
You bet. Thank you, Keith. Okay, so today's presentation, we'll probably try to keep this to about a half an hour and before we move on to questions. We're going to first talk about Portugal's growth as a key destination for expats and retirees. What's making Portugal such an attractive place, and what's causing the rising interest in Portugal. From there, we'll take a deeper dive into Portuguese tax programs designed to make Portugal attractive to expats, namely that non-habitual residence program. But we'll also talk about some other things that are less talked about, including estate planning reform in Portugal and generally in the EU, and its implication for U.S. expats and their existing estate plans. And then I'm going to turn over the mic for a little bit to Sil here, and Sil's going to talk about your retirement nest egg and what the rules are governing that, what the taxation of that might look like during and perhaps after the non-habitual residence program. At that point, we're going to tie everything together and talk generally about investment planning for somebody that's thinking about moving to Portugal. Where you park your money and invest it, the particular types of investments that expats should own, and investments that expats should avoid altogether. And then we're going to talk about, of course, tax minimization and how you manage your withdrawal strategies, perhaps before, during, and after your residency in Portugal with an HR and thereafter. All right, so Portugal is incredibly hot now. As an advisory team, I've been working with expats exclusively since 2014. I lived in Portugal around 2010, so 4 years later, back here on this side of the pond, so to speak, I didn't see a lot of American expat, interest in Portugal. I wasn't finding a lot of clients that were interested in Portugal, not compared to many other Western European countries like France, Germany, and the United Kingdom, which have always been hotbeds for Americans. So what's causing what I would consider a tsunami of interest at this point? I mean, it has gone 360 degrees to where it seems like more and more the majority of people that reach out to us here at Wachner Condon's, our expat team, are thinking about Portugal, or they're in Portugal, or they've made the decision to move to Portugal, and they realize that it's more complicated from a financial planning standpoint than they originally realized, and they're seeking help. Okay, and just to give you an idea, this morning I go to the CNBC app to see how the stocks are doing in the pre-market, how the foreign markets traded overnight, and also just to kind of see what are the hot stories that people are reading. And CNBC's phone app ranks the 5 most read articles over the day, and the number one article today is entitled, "This 52-year-old early retiree left the U.S. for Portugal with his family and spends $24.50 a month. Quote, we cut our expenses by 50%. And it's a rather in-depth article for CNBC. It's actually more than just a couple of paragraphs about Portugal being popular. It really kind of breaks down some of the key factors for this family and why they lived there.
And I would also note that the Los Angeles Times has recently published an article on that topic as well, May 12th. Yeah. Welcome to Portugal, the new expat haven. Californians, please go home. That's the Los Angeles Times publishing that, not me. And this week, or last week, I believe, the Wall Street Journal published an article, Want to Retire in Portugal? Here's what to know as Americans move there in droves. So it's not just CNBC, it's kind of sweeping the financial media.
Yeah. And so these articles touch on a lot of the points that I'm going to raise here as to, what Portugal has going for it that makes it so attractive. Okay. First, let's talk about, some of the not necessarily tax related things, but the relative affordability, just the cost of living in Portugal relative to some of its Western European neighbors, right? It's relatively affordable. If you live in some of the more expensive parts of the United States, it's going to look downright affordable to you to consider Lisbon or Porto, or even more attractive financially, no matter where you live in the United States, to live in some of the smaller, less populated areas of Portugal. If you're retiring, especially if you're retiring before you're eligible for Medicare, you'll find that one of the biggest, concerns for you is no doubt the cost of health care, right? If anybody's ever been, on ACA program in their state to insure themselves, you find the insurance rates astronomical, and the out-of-pocket expenses even after insurance premiums to be offensive, right? So if you're retiring and you leave your employment, you've got maybe COBRA coverage for a little while, but then you're going on that type of system to get your health care. Portugal's health care is of high quality, and it's extremely affordable compared to the United States. So that's one important component that I think needs to be emphasized. Okay. Beyond that, retirement's supposed to be where you get to kick back and enjoy your life and relax. And the Portuguese culture tends to be very relaxed. They enjoy a good 3-hour lunch, right? And the weather in Portugal, in my personal opinion, is the best weather I've ever encountered. It's constantly pleasant, and it's pleasant year round. It's not necessarily hot and sunny like Florida in the winter, but it's very livable. And of course, the food and wine in Portugal, the access to fresh seafood and a good port for dessert, or a fine red or white wine or green wine for that matter, right, is phenomenal. Okay. Now, the affordability of Portugal has gotten even better due in part to the fact that the dollar has been on a long-term uptrend, and conversely, the euro has fallen versus the dollar dramatically over the last decade. So that has only enhanced the attractiveness of selling your U.S. home and buying a home in Portugal. It's made it way more affordable, right? And just generally having your dollar nest egg, be it in your pensions or your investment or savings accounts, and being able to convert to euros at such favorable rates just makes it altogether more attractive. Okay. Beyond that, Portugal has a lot going for it without talking about taxes. And frankly, if before the Portuguese government intervened to attract expats to make that concerted effort, taxes would be in the negative ledger, right? But Portugal has made a concerted effort to fiscally make themselves more attractive and to cut a lot of the red tape in terms of their immigration policies. So through immigration policies and tax policies and legal reform, they've made living in Portugal financially even more appetizing by providing some relief and making it just more viable for somebody who has a complex financial life to consider living there, right? These latter two, the tax policy and legal reform, are certainly key drivers that influence a lot of the financial planning and investment management strategies that we help develop for our clients that are moving to Portugal. All right, so let's talk about NHR and what this non-habitual residence program is all about. Okay, NHR is a special tax status for certain persons relocating to Portugal can claim. And by relocating, even Portuguese citizens that have been non-tax residents for a 5-year period can even repatriate and get into the non-habitual residence program. So it's designed to attract affluent people living abroad to come there to live. Okay. The key benefits of the program are that most non-Portugal sourced income is not going to be taxed in Portugal during the NHR period. Okay. If you move to Portugal, and not necessarily to retire, but to continue to work in Portugal, there are incentives that the NHR program has put in place. There are certain segments of the economy that Portugal wants to enhance the labor force, so to speak, to bring in people who are skilled in certain vocations. If you meet those criteria, then your wages or earned income are taxed at a 20% flat rate for the NHR period. Okay. I said most non-Portuguese sourced income is not taxed. In 2020, I think due to pressure from the European Union, Portugal had to reform this program to put in a modest 10% tax rate on pension distributions received by NHR program members while living in Portugal from their foreign-sourced pensions, okay, during that period. So it's not no tax, but it's certainly low tax, okay? And then also note that there are some gray areas surrounding the taxation of U.S. income that we'll deal with later in the presentation. So how do you get into NHR, right? Well, first you got to become a tax resident, and then once you are a tax resident, you can start filling out the application to join the non-habitual residence program, okay? And this application needs to be filled out well ahead of this deadline to put in an application, which is March 31st of the year following the first year that you become a tax resident of Portugal, okay? So when exactly does that clock begin, right? So normally, tax residency in Portugal is established by having 183 days as within the country in a calendar year, right? You're living in Portugal, you're staying in Portugal with for a cumulative 183 days. It doesn't have to be a consecutive 183-day stay, okay? However, be aware of this, right? If you're going to always, that first year, unless you move on New Year's Day, is always a partial year, right? And if you move in the second half of the year, that may make you think, well, there's no chance of that first year I'm not going to be a tax resident at all, so I don't have to worry about these tax programs. I don't have to worry about filing Portuguese tax return for my partial year, and I don't have to worry about getting this application in well ahead of that March 31st application deadline in the following year. However, the Portuguese tax authorities made it clear that less than 183-day stay in the country could potentially cause you to become a tax resident if you move there, own your own home, and occupy it with the intent to treat it as your usual place of residence, okay? So once you've made that move, even if that move is, theoretically in November, December of, say, this year, that NHR filing deadline could be March 31st of next year, right? You want to make sure that you do this ahead of time in case there's any problems with the application, right? If you miss this deadline, you will not get into NHR, and you will find that they can be somewhat sticklers for this rule. So I want to emphasize that. Once the application is approved, the NHR status lasts for a 10-year period, okay? Now, during that 10-year window, all expats are different, right? So they're potentially, you could be, falling in and out of tax residency from year to year. You might be back in the States. There might be a family reason that causes you to spend the majority of your time back in the U.S. You could just be in the United States a lot, but also traveling around Europe a lot and fall out of tax residency. I just want you to realize that 10-year period doesn't get postponed or extended by periods of non-residency. Okay, if you become a Portuguese tax resident this year, you apply for the NHR in March. Your NHR period starts this year, 2022, and ends 2031, and that's it. Okay, let's talk a little bit about legal reform. Okay, not every tax-friendly place to live is a tax-friendly place to die, and it's nice when you're retired because ultimately the inevitable happens. It's nice to know that if that when you go, that your spouse is protected and your family is protected in terms of not getting overly taxed on the transfer of wealth. Okay, since 2004, Portugal has abolished gift and inheritance taxes, and that's a huge deal because there are lots of neighboring countries, Germany, France, the United Kingdom, okay, where unlike the United States, you have gifted inheritance taxes, which we do here too, but the exemption levels are so much lower that here in the United States, less than 1%, they say, of our population are currently impacted by the estate tax, okay, and the gift tax runs concurrent with it. So you'll find as an expat living in a lot of Western Europe countries that you can be middle class or upper middle class and still possibly have an inheritance tax problem, right? So that's important, right? Beyond that, kind of in conjunction around the time that they were making Portugal more attractive for American expats, there was also major legal reform regarding fiduciary structures, okay? And subsequent to this recognition of trusts in Portugal, we have to understand that Portugal is a civil law country, not a common law country, and trusts are common law creatures of law, not civil law, right? So they made some laws to recognize that there are lots of potential for foreigners to have these type of structures, and they needed to have some kind of rules of engagement, if you will, with trusts. All right. Subsequently, the Portuguese courts have had the opportunity to make tax rulings and interpretations of the tax implications and the legal implications of transfer of wealth through these fiduciary structures and trusts. And the rulings have been, more or less, for the large part, favorable in terms of the way they've interpreted the rules. And by favorable, I mean more consistent with the method and timing and ways of taxing the trust itself or beneficial distributions to a Portuguese tax resident from a trust, that more akin to the way that these things are taxed in the United States. Okay, so it's good to have rule books that are more similar to each other. Portugal's got out of their way to change their rule book to make it at least complementary to the U.S. rule book when it comes to estate planning. The EU has gotten in the game too, okay, and on the will side, right? Most Americans have a will. If you don't have a will and you're listening here, consider getting a will, okay? Consider having one, especially if you're, at the retirement stage, okay? In 2012, the EU adopted a regulation called Directive 650/2012, okay? And essentially, this gave people living throughout the Eurozone, which includes Portugal, of course, the ability to choose within their will whether the laws of probate or succession, the laws that would govern the distribution of their property when they die, would be governed by their residence country laws or their citizenship country laws. Okay, so you can elect U.S. law to govern your the transfer of your wealth, even should you die resident in Portugal. Okay, you have to follow this directive, And since you have to name this directive specifically in your will, that means that if this is the first time you're hearing this and this sounds like a reasonable thing for you to do, and it is, preferably before you even move to Portugal, it means you need a new will, right? Okay. Now, with all this being said, this is I'm saying that Portuguese tax reform have made trust the trust rules more complementary in Portugal. Does this mean that you are absolutely safe and clear to take your existing estate plan to Portugal with you without having it reviewed by Portuguese legal counsel? Absolutely not. You'd be foolish to. Okay, we're not a law firm. We're certainly not licensed to practice law in Portugal. We're not providing legal advice. We're providing general planning advice and pointing out legal issues where you may need to consider in combination with a qualified legal advisor. Just as we're not accountants, but we're talking about tax issues of a general nature and not providing direct advice.
One thing I'd note with relationship to EU Directive 650 2012 as well is that it's a good idea to have when you get in country in Portugal, generally there's a sort of European passport process involved. And so it's a good idea to find out what you need to get your will approved in the country of residence, whether it involves dealing with a notary or a lawyer, because that as well is a necessary step in kind of ensuring that the process moves as smoothly as possible.
Absolutely. Again, boots on the ground counsel from a local legal expert. Absolutely. Not just in terms of drafting the instrument, but any steps you need to take thereafter to make sure it's going to be honored. Okay, so I've talked a lot about NHR and estate planning reform in Portugal and Europe. Now I'm going to turn over the presentation to my colleague Sil here, who's going to talk more specifically about the rules of engagement concerning your retirement nest egg that you've built up here in the United States and things that you need to consider when you move to Portugal.
Sure. Thank you, Stan. And just a quick reminder for our attendees, we will be taking questions at the end of the webinar. And some of you have already submitted questions ahead of time, so thank you for doing that. But if you're listening, you should be able to type in your questions in the questions box of your control panel. So we won't get to the question until we are done with the presentation, but if anything crosses your mind, feel free to type it into the box and we'll get to it in the Q&A part of our presentation. So if you're like most Americans, it's likely that your retirement is secured by some combination of, maybe Social Security or maybe some other form of private pension that you've accrued over the course of your career, and probably some sort of IRA, Roth IRA, 401k combination, right? So in these next couple of slides, we're going to ask ourselves, well, okay, so I have these pension entitlements in the US and I decide to relocate to Portugal. What happens, right? So how will Portugal treat my US pensions for, locally under their local rules, right? So we're going to consider different types of pensions, and starting with maybe the most basic, the most fundamental, which is Social Security, right? What we often do when we deal with these questions is review the language within dual taxation treaties, right? So taxation treaties are agreements, bilateral agreements between different countries that relate to the taxation of assets and income streams on a cross-border basis, right? And the US has, I think, 75 or 77 or so different income tax treaties with different countries around the world. And it does have one with Portugal. And it's an important resource for you as an American moving to Portugal as you grapple with these questions of, how will this particular source of income, that particular asset is going to be taxed. Tax treaties are not they're not going to answer all your questions, and they are themselves, I would say, subject to interpretation. But nonetheless, they're important resources and a good starting point. So let's consider Social Security. In a nutshell, what the treaty will say is that Social Security can be taxed in both countries, right? So you're going to be receiving that income from U.S. Social Security. It will be taxable in the U.S. It will also potentially be taxable in Portugal. Now, going back to the slide that Stan presented earlier about NHR, Social Security would qualify as a pension under the terms of NHR, right? And if you remember, pensions are taxed one or two ways. They're either not taxed at all in the previous iteration of the NHR program, the pre-2020 program, or they are taxed at a reduced rate of 10% in the new post-2020, more EU-friendly, so to speak, version of the NHR program. So if you think about what that's going to mean for you in terms of how your Social Security is going to be taxed during your retirement in Portugal, it simply means that in the first 10 years, while you're still under the NHR program, you're going to be taxed at 10% in Portugal and at your federal income tax rate in the US, whatever that happens to be. You're not going to be double taxed, because what will happen is that you're going to claim a credit for any taxes paid in the other. In the case of Social Security, it's likely that the US will have the first right of taxation. And so the net result is going to be that you will end up paying the higher of 10% and your federal income tax rate, right? So in all likelihood, you're paying more than 10% income tax in the US. So your net tax position will effectively be that you will just be paying federal income tax on that stream of income for the first 10 years. If your income tax rate happens to be under 10% in the US, then you will be in a position where you may have some taxes to pay to Portugal under the terms of the NHR, assuming you're not grandfathered into the previous arrangement. Now, after NHR, things are going to change pretty dramatically, because then you may potentially be subject to Portuguese income tax, right? So again, the principle is the same, that you will have to pay the higher of the two tax rates, either your marginal income tax rate in the United States, federal tax rate, or Portuguese income tax, right? So one thing we should mention about Portuguese income tax is it tends to be higher, right, than US federal tax rates. So it is very likely that after the end of NHR, you're going to be in a position where your net tax position will be that you will be paying Portuguese taxes. So that covers Social Security, and I've spent quite a bit of time here explaining the principles, and because they're important and they're going to apply to a lot of the other revenue streams that we're going to consider. For example, if you have a private pension of some kind, and that could cover things like maybe a pension like a 401k, or a sort of annuity-like defined benefit pension that you may receive from an employer. Those would fall in the same categories here of generally private pensions that are tied to previous employment. And if you read the treaty, what you're going to find is that the treaty language gives taxation right to the country of residence, right? So in other words, what that means is if you live in Portugal, Portugal has the right to tax you on that income. So once again, during the NHR program, to the extent that those assets and those sources of income qualify as a pension, you would only be taxed at 10%, right? So still that really beneficial tax position. After NHR, you're once again going to get into a situation where you could be subject to the higher Portuguese income tax rates, right? And if you read the language of the treaty, you might think, well, look, the taxation right, you might find that the language of the treaty giving taxation right to the country of residence, you might think, well, look, that's great. It says here that effectively I won't have to pay U.S. taxes. Well, that's not the case, and I'm not going to spend too much time on it because it's kind of it's a pretty technical detail having to do with the language of the treaty. But all U.S. treaties include something called the savings clause, which effectively preserve the U.S.'s right to tax you on your worldwide income, regardless of other treaty provisions, right? So your tax position, again, when it comes to private pensions and 401k withdrawals, is going to be that you're going to have to pay taxes to both countries, and you're going to get credits in one country for taxes paid in the other. Now, if we move forward to the next slide, we're going to consider what happens with IRAs and Roth IRAs, and I haven't covered these types of assets so far because they fall in a slightly different category compared to the other assets that we've considered previously, and they kind of have their own potential characteristics, right? So if you consider IRAs, the way that IRAs are going to be taxed is going to be pretty similar to a 401k in the sense that, again, you may have the option under the terms of the treaty to continue to treat that asset as a pension. Therefore, it will continue to be a tax-deferred type of account, and you would be taxed only on the withdrawals. It would be a pension for the purposes of NHR, and therefore only subject to that 10% tax rate during the first 10 years, and then Portuguese income tax thereafter. And once again, you would have the opportunity to claim credits. Now, things get a bit more complicated when it comes to the Roth. And the issue with the Roth is actually not specific to Portugal. I would say it's an issue that affects expats in general in a number of countries around the world, in the sense that for those familiar with the Roth, the main benefit of the Roth is you effectively get to take tax-exempt, so tax-free distributions from that account under certain conditions after the age of 59 and a half. Now, that provision is purely a provision in U.S. tax rules. And there is no specific language in the treaty that protects the tax-exempt nature of that distribution. So there's no treaty language that you can point to and say, well, look, Portugal has to honor the tax-exempt nature of that Roth distribution, right? And again, that happens in many countries around the world. With a few exceptions, there's some treaties like the one with Canada, with the UK, with Belgium, with some of the Nordic countries that have specific language that relates to the Roth, but that's not the case with Portugal, right? So that creates a bit of a gray area and a risk that your Roth conversion would turn out to be taxable simply as a pension once you move to Portugal. So that's an important consideration. Now, so related to that, there's an important factor to consider here is that while you have the option to continue to treat those IRA and Roth IRA accounts as pensions, you may also have, as you move to Portugal, the ability to effectively recharacterize those accounts and basically elect to not treat those accounts as pensions, so not treat them as tax deferred, but treat them as capital assets instead. So what that strategy involves is basically taking an IRA or a Roth IRA and saying, well, you know what, forget the IRA structure around it. I'm just going to treat this as a brokerage account, right? So pretend it's basically the same as, an account in your name, right? And that would apply solely to Portuguese taxes, right? So it's sort of an election that you may be able to make. And so you might be wondering, well, why would anyone make that election, right? Because the whole point of these accounts is in the tax deferral. But now remember, taxes under the NHR program are such that dividends aren't taxed, interests aren't taxed, and capital gains may be taxed, but capital gains only apply if you actually realize a gain, right? So if you think about what that means in terms of potential strategies, it really opens the playbook in terms of doing things like, realizing all your gains in the IRA or the Roth IRA prior to moving to Portugal, which would be tax neutral, of course, under US rules. And then effectively moving to Portugal and starting fresh with an account that has very high cost basis, very low unrealized gains, and the ability to liquidate at preferential rates. And remember, even after the NHR program, even after your NHR period expires, Portuguese capital gains tax rate are 28%. Income tax rates in Portugal are very high, and depending on your income, they can go, up to, 45, 50%.
48% is the highest tax bracket, and it's like above 80,000 euros. And that may sound reasonable to some pensioners, right, who are paying ordinary income tax rates eventually post NHR, right?
Right.
But it's deceptive because there's a 45% tax bracket that kicks in the 30,000 euro band, right? So you get up to rates that greatly exceed the highest marginal rates in the United States very quickly.
Very quickly.
You don't have to be wealthy,
right,
to be taxed at rates that even the most wealthy people in the United States don't see,
right?
At least at the federal level.
Right, exactly. And just to wrap up then this section about pensions and IRAs, you want to consider that option, right? So, but it depends on your own personal circumstances. It depends on a number of factors, including, your level of income, your marginal tax rate in the US, what other assets you have, what ratio of IRA versus Roth assets you have, what your retirement spending needs are. But depending on your circumstances, it might be an option that makes sense to consider.
Yeah, thanks, Sil. And I think that begins to tie into, kind of how we want to wrap up our presentation, is that, Sil just talked about a lot of different complex issues that are probably a lot for you to unpack while you're listening to this webinar. This idea of conversion, which, another way of looking at is simply, well, okay, my pension, my IRA can be treated as a pension. It's a right of mine to claim that treaty benefit, but treaty benefits don't have to be claimed, right? And so it's just simply, well, I'm going to let you go ahead and start taxing this, Portugal. It's just an ordinary brokerage account. That's the decisions on that. And the decisions on so many different things involve a lot of moving pieces about your circumstances, as Sil started to intimate, okay? And when it comes to strategic planning and investment planning for expats in Portugal, there's a lot of different things to consider, okay? So we're going to break down just in a general way different things that you should be thinking about, you should be working with an advisor about perhaps, or at least considering that before you make the move, okay? Things involving like where am I going to park my money when I'm no longer living in the United States? Do I take it with me? Do I leave my investment accounts stateside? How do I navigate these two different sets of tax rules? Okay, how do I position myself to be tax optimized with my nest egg? Okay, part of that is, well, maybe what do I do with my Roth, right? I mean, gee whiz, I'm not going to get tax-free treatment. And then, of course, withdrawal strategies. How am I going to live on that nest egg for my stay in Portugal? How long is that stay in Portugal? Okay, so lots of different challenges here. Even at the threshold, where to park your investments. Okay, so there's always the temptation when you fall in love with another country and you want to make it your home, to treat it like your home. And that means I want to have a relationship with a financial advisor there. I want to have my accounts there. I want to have, everything there, just like every other, expat from every other country might want to do. And I want to have my money in euros, right? I don't want to have dollars because the euro's really low now, but buy low, right? Dollar's high now, sell high. It makes sense, right? It's a very toxic decision that expats often step into that I want you to avoid, right? We all do. And the number one rule, I think, when it comes to advising expats is that you never want to go fully native and invest in overseas registered mutual funds, ETFs, tracker funds, private equity funds, hedge funds, any type of pooled investment, because the IRS has special tax rules, forms that need to be filled out, disclosures, and a separate tax regime in how these assets are taxed. Okay, these are known as the PFIC rules and the PFIC tax regime. And that's an entirely separate presentation, and I'm not going to get into those rules, but let me tell you something. If the 48% Portuguese income tax rate offends you, wait until you see what happens to your long-term capital gains treatment if you own PFICs, right? You lose it, and you're going to have not just taxes, but accounting costs that go through the roof, okay? It's a nightmare that you need to avoid in taxable accounts, your capital accounts, okay? And your pensions, right? It may be, well, what about pensions? Those aren't subject to the PFIC rules. Well, pensions in the United States don't port abroad, okay, with a rare exception of the the RRMA or SBA in Canada.
RRSP.
For RRSP, thank you, Sil, for IRAs that you could move to Canada. Otherwise, this don't exist. So, that money's got to stay home anyway, right? So you need to keep your investment nest egg where the IRS won't trash it and destroy it and take it away from you. You need to keep it here because the ERISA rules won't let you move it abroad if you're talking about pensions and IRAs even, right? The second challenge here is that the EU and Portuguese regulators, they communicate with the brokerages here in the United States and they say, if you want to do business here, here's what you got to do. And they've discouraged most of the U.S. custodians from wanting to service Portuguese tax residents, period, right? If you're a legal resident of Portugal, most of them don't want to have anything to do with you, okay? That leaves you with, very little choices as to how you can do that. Now, again, I want to wrap up the presentation here shortly. We have a white paper on the best brokerages for expats, and it's not Portuguese specific. So if you're having, if you want some guidance on these issues, feel free to reach out to us. But this is one of the more important things that we help all expat clients deal with, is providing them a custodial solution that's not us, by the way, but a U.S. registered broker. And then, of course, strategically being prepared for the fact that if that brokerage gets discouraged or shooed away, what would be a good plan B for said client, okay? The greatest challenge, in my opinion, because that one, once it's overcome, it's done, right? I mean, you hope. Anyway. Rules can change, and you could, theoretically, the custodial issue could reemerge. But the ongoing challenges, okay, is, frankly, that I can't give you a presentation that outlines a generic one strategy fits all for Portugal. There is no one Portuguese strategy when it comes to how your investments should be allocated between accounts, how to be tax optimized both in Portugal and the United States, and how, especially how to develop the right distribution strategy. Is Portugal a pro rata distribution strategy country, or is it brokerage first, pension second? I mean, the answer is depends, right? There's no one strategy fits all for U.S. expats in Portugal. There are many factors that are going to play into the development of the right strategy for you, and it should be personal to you, and it should be understood by you. One of the critical factors simply is how long will you remain in Portugal? Okay, let's take that recharacterization for example, right? The longer you're going to remain in Portugal, the more attractive the idea of paying taxes during the NHR program on your pension account, not just on distributions from it, but on the capital gains within it, if any, becomes attractive, right? Because eventually you're going to pay the piper. You're going to pay ordinary income tax rates, which go to 45% above 30,000 euros a year, right? And versus the 28% capital gains rate and the tax on dividends as well, right? Much more favorable. So long-term planning would suggest that you give that more consideration, the greater the possibility you're going to be in Portugal beyond the 10 years. But you only get one bite of the apple in terms of whether you do this or not. And if you do this and you later regret it, it just means you might have left some money on the table that you paid taxes where, you ended up not needing to, because by the time you would be subject to tax on the pension in Portugal, you're no longer there, right? You're either back in the United States or you found some other tax program that can keep you in tax bliss somewhere else, right? So other critical factors, right? Okay, so no two expats are alike because they're going to have a different mix of assets that they're going to utilize to finance their, not just their retirement, but their legacy goals, if any, leaving money to loved ones, gifting to, supporting family members, supporting philanthropy, whatever, right? There's a different mix of Social Security, pension, IRA, Roth IRA, and brokerage assets, okay? So the answer, again, what do I do about my Roth IRA? Do I take any distributions? Do I convert it? Or if not, do I ever take a distribution from it while I'm in Portugal? I mean, a big part of that factor is going to be how big is that IRA relative to the Roth IRA relative to your entire nest egg, right? So there's just no one strategy, okay? Now, with all of these, and there's other important factors, your age, the unrealized gains that you have in your brokerage account. Sil talked about if you do recharacterize that you should certainly reset your balance before the day one of your tax residency in Portugal. But your capital gains position, your tax basis, what your goals are, both in terms of how much you're going to be pulling on these accounts during early retirement versus later in retirement. A lot of people want to be partying in Sicily and then on to Monaco, early on while they're still young and fit, right? And then they might by the NHR time they may be pulling less. Right? So there's just all kinds of different factors. And with all of those different things to look at, in my experience, financial planning tools are critical to developing tax optimal investment and withdrawal strategies to achieve both retirement planning and potential legacy estate planning goals. Okay, so we not only invest in the technologies to be able to do this, but it's just experience working with people under different tax regimes using U.S. software and being able to work that all out that I think is something that professionally we've spent a lot of time working on, right? So I'm going to wrap it up there, and we're going to start fielding some of the questions. I want to thank you for your patience. I think we went a little over time there, but we hopefully talked about a lot of things that you found useful in terms of information about Portugal and about expat life in general, about financial planning and investment management for expats. So appreciate your time. We're going to move on to your questions. A lot of questions, again, there's going to be general answers. But if you want one-on-one personal discussion of those things, please feel free to go to usexpatinvesting.com and schedule an appointment to talk with myself, Keith here, or Sil.
Really, really quite convenient there with the website in that you can jump right on there and book an appointment directly with Stan, Sil, or I right there. We have some questions that have been submitted already, so I'll take those and put them out to the panel. The first question comes from Warren, who asks, what is the status of health insurance and income tax payable on 401k withdrawals and Social Security payments, dual taxes to U.S. and Portugal? I think we covered that, Stan, but maybe you want to address in a little bit more depth, Stan and Sil, some of the tax issues there.
Right. So this is interesting. We clearly talked about 401k withdrawals. There's no recharacterization potential there, right? If you leave it in the 401k. So a decision may be before you move to Portugal whether you want to remain in the 401k. Okay. If you do remain in the 401k, the rules are straightforward. There's no optionality. Okay. If you take distributions during the NHR period, you're going to pay 10% tax to the Portuguese tax authorities, right? You're going to pay a flat rate of 10%, dollar for dollar, on your 401k distributions. Now, if you are beyond, and obviously you're going to pay ordinary income tax rates on your federal U.S. tax return. Portugal has the first right of taxation there. So you pay the Portuguese tax, euro for dollar, that produces tax credits that are creditable against the tax you owe on your U.S. 401k distributions, right? So let's assume that your effective tax rate in the United States is 12. Well, that's going to reduce your tax in the U.S. down to you still owe 2%, basically, right, on those distributions. Now, as far as Social Security goes, Sil was right. So you pay tax in the U.S. that's usually withheld from your Social Security check, right? You get Social Security withholding, and then the Portuguese will want to tax that 10%, but they have to offer you a foreign tax credit against the U.S. tax you hold. So same outcome. Like there's a net tax that's either the higher of 10% or your effective U.S. federal tax rate. Okay, but kind of a different order of things. And don't try to do your own taxes. I think we've just pointed out ways that make you crazy to try to do your U.S. or Portuguese tax returns without some professional guidance.
Yeah, I think when you first start, especially, having some professional guidance makes a lot of sense. With relationship to that as well, one thing that people worry about is that they're going to get double taxed, and that happens. But the tax treaties eliminate a lot of the common double taxation situations, as Stan sort of described.
Let's talk about health insurance. He mentioned it.
Oh, yeah.
Right? And I think that's, again, a really important thing for early retirees, right? Because it makes living somewhere with affordable health care just all the more attractive, because it's one of the least affordable things about being retired early in the United States. Okay, so in Portugal, you have a national health care system that basically covers every tax resident. So you don't have an enrollment period where for the first 5 years you're on your own. So you have that protection. If you want better access to better care, there are HMO type setups for private health insurance, right? So you go through certain clinic groups. One of the bigger ones is known as multi-care, okay? But there's another one called Fidelidade, right? So multi-care, Fidelidade, I'm sure there are many more. And, I would certainly recommend getting enrolled in one of those for your family when you're over in Portugal because, read that CNBC article. It's really enlightening, right? And
Warren notes in his question as well that he has dual citizenship, U.S. and Luxembourg. Having several citizenship or having an EU passport, has no impact really on your, U.S. tax position, right? You don't get a special treatment of any kind. The only question is, are you a U.S. citizen or not? Having a Luxembourg passport, or French passport, or Portuguese passport for that matter, changes nothing.
Right. So Maya asks more direct questions about custodian stuff. She says, after 10 years of NHR program, how does the tax treaty work? And she says, can we keep our investments in the U.S. while living abroad? What brokerage firms allow that? Which banks in Portugal accept U.S. citizens as customers? All right. Again, not going to go through the white paper, but I'm going to suggest that, first of all, the NHR question. I think we answered that during the presentation. Okay, so you go from having most of your U.S. nest egg not taxed. Capital gains, by the way, we really didn't talk about the recent tax decision.
And there's actually a question from Sean here about that, so we'll go to that next.
Let's save that, right, for that question, okay? But think about it this way: you go from a very low tax environment to an extremely high tax environment, okay? And how does the tax treaty work? The tax treaty is going to give, in terms of your retirement resources that you have in the United States, once you're a tax resident, you're subject to, and you're no longer in an NHR program, you're subject to taxation in Portugal on your worldwide wealth, right? Your worldwide income, I should say, right? So income from all sources, including all U.S. sources, right? So NHR is no longer sheltering you from that. So you're looking at 45% marginal tax bracket above 30,000 euros of income that you're flashing per year, and then a max tax rate above 80,000 euros of about 48%. Okay, so it's a dramatic change. So people need to give Portugal a good look, but they, longer term, they also need to take a hard look. One of the things that quite honestly disturbs me a little bit is that, we've seen people retiring earlier and earlier lately, right? And so the challenge is multifold here. And longevity risk becomes larger the earlier you retire, You might be enjoying good quality of living in Portugal during NHR, but the nest egg has to last well beyond NHR, right? And if you're using NHR math to determine whether or not you can afford to live the rest of your life in Portugal, that's just simply flawed, right? Because it's just the first 10 years of retirement.
Well, and I also think if you're relying on NHR math and you're not thinking about those extra 10 years from a planning perspective, there are certain cases where it may make sense to take required minimum, take distributions from your IRA before you have to, right?
Absolutely.
Get yourself in that lower tax, take them out when they're in a lower tax bracket than when you shift over to Portuguese. Think about even if you're not going to use, the income from your IRA, think about Roth conversions for estate planning reasons. So I think, the concept of just living in that 10-year chunk is something that you want to step back from. And this is also something that Joe mentioned in her comment is, I'm interested in post NHR tax implications. And it's a case where really it's going to be specific to each individual and their situation. This is a question more for Sil, I would say, specifically. William asks, you say you may be able to treat IRAs like brokerage accounts. What does the may hinge on?
Well, I mean, we're always very careful with our language. So we tend to use may by default because it is true that we deal with a lot of very complex issues and a lot of gray areas. Right. So sometimes may means can, but in this case, may does mean may in the sense that there's a couple of things to keep in mind. I think what's important is that it's not something that it's effectively something you need to determine once, and you don't get to sort of go back and forth. And you don't get to really change your mind. So if you make that determination and make that election, you can just kind of go back and tell the Portuguese tax authorities that you've now decided to treat it as a pension.
Right. So, again, we're not tax preparers, and we don't work with these forms that are in Portuguese. I can speak a little Portuguese, but I certainly don't read it very well. But at any rate, think about NHR program as you're moving to Portugal. You're making certain financial disclosures to the Portuguese government. So even though you're not taxed on much of your U.S. sourced income, they want to know everything about your financial assets. So you've got one opportunity to disclose these assets and how you disclose them and the nature of those assets, right? So it has to be done correctly, and frankly, I think, again, it needs to be done with a not just a Portuguese accountant, but a Portuguese accountant who's really familiar with working with, Americans, right? So that they understand that, this strategy and they're on board with this strategy. If you're working with somebody who doesn't understand the strategy or doesn't, understand you, and while you're communicating that you want to do this, it may not get done. And if it doesn't get done, you're done. Right.
Another question here that we've kind of been batting around here in the office from Sean that we sort of alluded to is interesting note about the Portuguese IRS losing a case in tax court about non-Portuguese capital gains. Any more information about that? And this is a sort of interesting case, and maybe one where taking a wait and see attitude is probably the best. In summary, the Portuguese IRS thought they would be able to tax non-Portuguese capital gains under the sort of terms of the NHR.
On portfolio income.
On portfolio income. Under the terms of the NHR questions here, tax court ruled that they couldn't. The Portuguese IRS went, don't care, we're still going to do it, essentially.
I mean, that seems to be the position, right? So first of all, let's understand one thing about capital gains. Okay, so the Portuguese treat capital gains from real property and intangible personal property differently, right? So they treat your portfolio income, that passive income, as intangible personal property, right? And the Portuguese tax authority was of the opinion that the tax treaty says, hey, that's going to be treated as Portuguese sourced income, right? That's how I unpack this anyway, because I read these treaties, and when I was first starting to work with Portuguese clients, U.S. expats in Portugal, I was trying to unpack how NHR somehow still gave Portugal the right. And the answer is in the tax treaty. But the reason why the Portuguese tax authority lost this court decision to the 3 arbitrator panel is also found is actually found in the tax treaty and the NHR program rules. Okay, so the NHR program basically broadly said that offshore income is not taxable and never taxable in the case that the home country of the NHR participant has the right to tax. Okay? If you read the tax treaty, it says that the Portuguese have primary tax authority over this intangible personal property, as opposed to like rental income or the sale of your property, right? The sale of your real estate in the U.S. where they agree. They don't have the right to tax it. But with portfolio income, they're like, aha, we can tax capital gains there. But they're neglecting the fact that the savings clause, again, comes in and says that nothing about that section prevents the United States government from fully taxing its citizens for that income, right? So the panel ruled that because of the savings clause, the U.S. is still taxing this. Therefore, under the clear rules of the NHR, they can't. Just like before they wouldn't tax pensions, they had to literally change the NHR rules to put in that 10% tax. They didn't do that for capital gains, right?
Yeah, and that was the 10% was also the result of another sort of European court ruling that came in. So one final question is from Caitlin, who asks how to meet income requirements for early retirees pulling from investments who don't have access to Social Security or a pension. How do you meet those income requirements? One case too, this is a case where as you're going through the visa process, and attorney can always be helpful. And one of the things that we frequently do for our clients is provide notarized letters, even in the language of destination concerning portfolio, possible income from the portfolio, certain things like that. And each lawyer that's helping you with a visa process may have certain things that they recommend that you do as well. So that's something that we've done for clients in the past. But Stan, what about these income requirements?
Caitlin, that's a great question, right? And I think it goes back to this whole issue of, am I ready to retire, right? I get this a lot, and you need to do, obviously, the long-term math, and working with a financial planner may prove, extremely useful in this. But, if you're retiring super early, it's not tax-friendly to pull from your pensions. You may not be eligible to pull from the company pension. There may be penalties involved if you do. You don't have access to Social Security yet, and Social Security, income is reduced if you start taking it early anyway. So really, what it comes down to is, what other assets do I have? I need to have a nest egg outside of these assets, the pension assets, okay? And I need to know that it's viable for me to live on these assets until it becomes optimal for me to pull from my pensions and start taking Social Security, right? It doesn't necessarily mean that you have to have, a $2 million brokerage account. It's helpful if you do, obviously, right? But it means that you need to have, other buckets of capital, whether it be an existing brokerage account or whether it be, real estate that's kicking off an incredible amount of rent, but really like, net rent, like after taxes, including property taxes, upkeep, insurance, etc., right? That's cash flowing enough for you to live on. Or it could be, you have a house in the San Francisco Bay Area that's, gone up 3,000%, over the last 2 decades, and you sell it, you take the one-time capital gains hit, but now you have this huge financial resource that you can pull on while you wait for Social Security and your company pensions and IRAs to become available to you.
Sounds good. That looks like the last of our questions there. Just a reminder for you up on the screen, just some legal disclosures for you to read over and look at. We're not going to read those in a very fast voice. For Stan and Sil, I'm Keith Ponywas. I want to thank you for joining us. And should you have further questions, feel free to reach out to us at info@wachnercondon.com or check out our website, usexpatinvesting.com.
Yeah, if you're watching a replay of this presentation on YouTube and you like the content, consider subscribing to our channel. If you're attending this webinar live, search out our Wachner Condon Expat channel on YouTube. Consider subscribing and, of course, hit that like button.
Thank you very much.
Thank you.